Ladies and gentlemen, Archivist here. If you want to understand where the next global conflict is heading, stop watching aircraft carriers in the Taiwan Strait. Military hardware is just theater. Ships can sail out for drills, send a message, and then quietly return to port. Tanks, jets, and military exercises are designed to be seen, but real intent hides elsewhere. If you really want to know whether a superpower is preparing for a permanent, irreversible break with another, you don't watch the missiles. You watch the money. Specifically, sovereign debt. Debt is the foundation of our global order. It's heavy, it's slow to move, and it cannot be shifted quietly or quickly without massive consequences. When a nation starts unloading huge amounts of another nation's debt, it isn't just sending a signal, it's preparing for something big. And this week, the data finally spoke. Buried inside a US Treasury report, one of the driest, most ignored documents in global finances, a signal that Wall Street has spent a year trying to dismiss. China's official holdings of US Treasury bonds have fallen to $688 billion. Now, to most people, that still sounds like an enormous amount. But in context, it's a financial earthquake. This is the lowest level China has held since 2009. 16 years of financial integration between the two largest economies on Earth, just gone. To give you some perspective, at the peak of the US-China economic relationship back in 2013, Beijing held $1.32 trillion in US debt. China financed America's deficits, and in return, America consumed China's goods. It was a perfect closed loop that kept interest rates low and global trade humming along smoothly. But that loop is now broken. China has liquidated nearly half of its peak position. Over $600 billion worth of US bonds vanished. But the number alone isn't the real story here. The timing is China has been selling aggressively during one of the worst bond market downturns in modern history. Yields were volatile and prices were depressed. Anyone selling us treasuries in 2024 was basically locking in losses. In the world of asset management, you do unsell at a loss unless one of two things is true. Either you are desperate for cash, or the asset itself has become dangerous to hold. Well, China is not short on cash. Despite stress in its real estate sector, the country runs massive trade surpluses. Liquidity is not the problem. That leaves only one other explanation. This realization was likely born in February of 2022, when Russia invaded Ukraine. The US and its European allies froze $300 billion of Russia's foreign exchange reserves overnight. Money that Moscow believed was untouchable simply vanished with a few keystrokes. Beijing watched this very carefully, and they learned a brutal lesson. In a real conflict, US treasuries are not assets. They are hostages. This creates a serious problem for America. For decades, the US could run enormous deficits because there was always a reliable buyer in the East who didn't really care about the yield. China simply recycled its trade surpluses into treasuries, but that buyer is now gone. So who is absorbing all the bonds that China is selling? If you look closely at that same treasury data, a strange pattern appears. As China sells to other countries, see their holdings spike, the United Kingdom and Belgium. The UK now holds over $750 billion in US debt, nearly matching China's former position. Let that sink in for a moment. Britain's economy is a tiny fraction of China's size, and it runs a trade deficit, not a surplus. So where is all this money coming from? It's not coming from profits, it's coming from leverage. London is stretching its own balance sheet to act as a shock absorber for the US bond market in Belgium. Belgium isn't actually buying anything. Belgium is home to Euroclear, which is basically the plumbing of global finance. This is the bag holder alliance, but it has a fatal weakness: capacity. When China sells treasuries, they receive dollars, but they don't keep them. Dollars are traceable, sanctionable, and can be inflated away. So what are they buying instead? Everything that survives a war, they're buying gold relentlessly. Officially, they've been buying for over a year straight. Unofficially, it's likely far more. Gold has no counterparty risk. It can't be frozen with a keystroke. They're buying oil massively. China is filling its strategic reserves, buying from Russia and Iran, and preparing for potential blockade scenarios. They're buying copper, lithium, and rare earth metals, even as their own property construction market collapses. These are not commercial purchases. These are war inputs. And they're buying food on a staggering scale. China now holds the majority of the world's grain reserves. They're choosing calories over yield, survival over returns. This shows the difference in mindset. A nation planning for peace chases financial yield. When they start to crack, the Federal Reserve will have to step in not to fight inflation, but to save the bond market. That will be the real pivot. That $688 billion figure isn't just a statistic, it's a countdown. The divorce is over. We're just waiting for the house to be sold. Archivist out. Protocol is active. Thank you for watching. Be sure to subscribe for more insights.